Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of discussion is the how to legally pay $0 in the taxes as an investor. So here we will discuss tax efficient investing, 7 ways to minimize taxes and keep more of your profit. If you are investor, be sure to give special attention to the taxes you will have to pay on your investments. In many cases you have ways to legally reduce, defer or even eliminate taxes on the investment gains and keep more of your profit. So it pays to know the smartest ways to minimize your taxes and keep more of your money working for you. So here are some of the best ways to keep taxes low on your investment income. Key takeaways include: investments are a great way to build up extra income in both the short and long term, but you will get taxed at those investments. The IRS taxes your investment income just like it taxes your regular wages, but you can reduce your investment taxes if done efficiently. Different types of the investing can have different tax benefits depending on how much you earn, as well as when you will earn those rewards. How your investments are taxed: the Internal Revenue Services (IRS) taxes your investment incomes, but it does so differently from how it taxes income from the working wages. Those differences include not only the tax rates you pay, but also when and how taxes are assessed on the investment income. Broadly speaking, investment generate income in 2 ways, and each is differently for the tax purposes. Capital gains are the increase in the price of an asset. For example, if a stock or a real estate property goes up in value, in general, the government taxes capital gains only when they've been realized and asset has been sold for a cash. Dividends or the cash income: dividend or cash income is the money received during the year, and it's usually subject to taxes for the tax year in which it was received. So investors was looking to minimize their taxes to have work around these broad rules. So here we have 7 ways to minimize investment taxes. You have a number of ways to minimize taxes on the investment gain, ranging from the behavioral to tax advantage account to efficient use of the tax codes. The number one is practice buy and hold investing. You are only taxed on realized capital gains or when you sell an investment for the cash. That's a huge legal loophole for you to jump through. As long as you don't sell, you wouldn't be liable for capital gain taxes, which can be substantial. In fact, you can hold your investments indefinitely and permanently defer any on gains, but that's only one side of the benefits of the buy and hold approach. Your investment will likely perform better if you buy and hold. Research consistently shows that passive investing tends to outperform active investing over the longer periods. This is good news as you'll likely make more money and you'll pay less of it to the IRS. Open an IRA. An IRA is a great way for the workers to invest their income for retirement and get some extra advantages. A traditional IRA let you put away money on a pre-tax basis, reducing your taxes. Right now, you'll be able to defer any taxes on your profits, either capital gains or the dividends, until you are 59 and a half years old. Then you will pay taxes on any money taken from the account when you make withdrawals, legally deferring taxes in your IRA for the decades. If you want to get the IRS out of your pocket for your goods through, though you can open a Roth IRA. The Roth IRA lets you put away money on an after tax basis. You wouldn't get a tax break this year, but you can grow your contribution tax free and then withdraw it tax free when begin taking distribution after 59 and a half years. You will want to carefully consider which plan, the traditional IRA or the Roth, fits your needs better. So, whichever you choose, it is important to closely follow the rules, since you get hit with penalty taxes if you make the misstep. Don't avoid taxes only to fall in another tax trap. The third one is contribute to a 401k plan. An employer sponsored 401k plan offers many of the same tax advantages of an IRA plus a few more. A traditional 401k let you defer money from your paycheck on a pre-tax basis, reducing your taxes. This year you will be able to defer taxes on any earnings, either capital gains or the dividends. When you take distribution from the account after 59 and a half year, you will pay taxes on any withdrawal. Effectively, you can defer investment profits or for the decade while you work. A Roth 401k offers many of the same benefits as a traditional 401k. Paycheck deferrals, an employer match, and more, but does so an after-tax basis, meaning you will still pay taxes on any contributions. However, this can you can grow. You can grow account tax free and then withdraw any money tax free when it's time to take distributions. You can even roll it into the Roth IRA later on. Both types of the 401k plans are very popular with the workers, and you'll want to carefully consider which plan is better for you. Again, it is important to carefully follow the plan rules, especially on the withdrawals, so that you can avoid an unnecessary bonus penalties that the IRS levies. The fourth point is take advantages of the tax loss harvesting. It can be smart to use tax loss harvesting to reduce or eliminate your taxable capital gains. With tax loss harvesting, the IRS allows you to write off realized investments losses against your gains, so you will owe tax only on your net capital gain. For example, if you realize a $10,000 gain on one investment but you have $8,000 loss on the another, you can offset them. You will wind up with a taxable gain of just $2,000 and much smaller tax bill. The IRS even allows you to offset more then you have gained up to a net 3,000 loss in any tax year. If your net losses are bigger than that, you will have to carry them forward to the future year. For example, if you realized a gain of $10,000 in one investment and a $15,000 loss in another, you will have a net loss of the $5,000, but you will be able to claim only a $3,000 loss in loss on this year's tax return, while the remaining $2,000 loss can be claimed in the future tax year. Some investors make a habit of minimizing taxable gains. This way, they may end up repurchasing the investments if they like it longer term after a 30-day period to avoid a wash sale. The fifth point is consider asset location. Dividends and the other cash distributions are generally taxable in the years you receive them. So if you are using a taxable account, you don't have a great way to wiggle free of taxes here as you do with capital gains. To keep taxes low on the dividends, consider where you hold your assets. For example, you may have a tax advantaged account such as an IRA and a regular taxable brokerage account. If you have dividend stocks, it may make sense to keep those or most of them within a tax light confines of your IRA, so you avoid taxes on distributions today. Meanwhile, stocks with probable capital gain could be held within a regular taxable account. Yet, in taxable account, you can still enjoy one of the IRA's key benefits: tax deferrals until you sell your investment, potentially decades, and the later, but you will want to carefully consider whether stuffing all your dividend players into the IRA makes the most financial sense for you. Use a 1031 exchange. If you are a real estate investor, you may want to use 1031 exchange if you are selling a property that isn't your primary residence and looking in to reinvest in another. The 1031 is like kind exchange, allowing you to sell one investment property and defer your capital gains as long as you quickly invest and proceeds in another investment property. The rules surrounding a 1031 exchange can be complex and must be followed exactly, or you will lose your tax deferral like other type of the assets. You can hold on to your investment and the defer capital gains potentially for decades. Plus, you will avoid those high real estate commissions. Then comes the next is the tax advantage of the lower long-term capital gain rates. Investment income is taxed differently from the wages income. That may be especially evident in a way that capital gains are treated. The IRS tax long term capital gains are at 15%, 20%, and 0%. Yes, 0%. But you have to follow the rules very carefully. These tax rates are typically lower than what you will pay on the short term capital gains, which are taxable at the ordinary income rates. But if you hold your investment for more than a year, again, another benefit of being buy and hold investor, you will be able to take advantage of the long term rates, which are likely to be significantly lower. If you are an individual filer and earn less than $47,025 in ordinary taxable income, or married with less than $94,050 in 2024, you can avoid taxes on capital gains and qualify dividends at least up to a certain threshold. If you earn too much ordinary income, however, you wouldn't be able to qualify for the 0% rates, and you will start paying investment tax at higher rates. For example, if you filed as married and had no ordinary taxable income, you would be able to claim a 0% rate on the long term capital gains and qualified dividends of up to $94,050. Any incremented uh, an increment. In contrast, if you had ordinary taxable income of the $20,000, you would pay 0% on that tax on your next for $74,050 in long-term investment income that is up to $94,050 threshold. From there, you would pay at least 15% level until your total income passed $5,83,750, and so on as before. So if you have years where your income is lower than normal, you can realize that 0% investment tax rates and even step up the cost basis on your investment with no tax rates. So here we will discuss selling stocks and bonds, 6 steps to help trim your tax bill. So, talking more about this topic, even when you are investing for the long term, you may want to sell stock along the way. Perhaps you need to get your portfolio back to your target mix after a period when stocks outperformed bonds, or you may need to raise cash for your upcoming retirement or a major purchase, or market volatility has you rethinking your tolerance for taking investment risk. No matter the reason, when you sell investment that have gained in value, you may be looking at the significant tax bills. Here are answers to the most common questions about the federal income tax consequences of selling assets and what you can do to minimize how much you owe. State and the local taxes may also apply, so you should consult with your tax advisor. So content includes the How are the stock bond taxed? How can I reduce capital gains tax? Can I avoid capital gains tax? Does reinvesting reduce capital gains? How are the mutual fund taxed? What if stocks or bonds are part of my estates? So the answer to the first question, how are the stocks and bonds tax, is when you sell an asset like a stock or a bond for a gain, your potential federal income tax liability depend on two factors: how long you own the asset and where you hold it within a tax deferred account like a traditional IRA or a workplace retirement plan. You will not owe federal income taxes or any gains from selling investment until you withdraw earnings and the contributions outside of a tax deferred account. Timing is crucial. If you own the asset for a year or less, your gain will be taxed as ordinary income with the rates currently as high as 37%. For stocks or bonds you owned for the more than a year, you could face a capital gain tax as high as 20% on your profits. Rates vary depending on your income. Even a 20% tax may be a small price to pay for the success, say Joyce Curtin, head of portfolio management, chief investment office, Merrill and Bank of America Private Bank. You can celebrate keeping the 80%. Stock dividends may also be subject to these favorable capital gains tax rates as long as they qualified with, which is based in part on how long you've owned the stocks. If not, ordinary income tax rates apply. Bond interest payments are taxable as ordinary income, but federal and the state tax treatments varies depending on the type of the bond, municipal government or the corporate. How can I reduce capital gains taxes to potentially minimize the taxes you may owe? Discuss these three strategies with your tax professional. So can I avoid the capital gains taxes? For the most part, no. However, there are a few instances where you may be able to. When you sell your primary home, for instance, you may be able to exclude up to $5 million in capital gains, but from your taxes if you are married couple filing jointly. Here are the other strategies to consider. Does the reinvesting reduces capital gains? Real estate investors can employ certain tax strategies to potentially defer gains on the scale of a property, but with stocks, reinvesting your gains does not reduce the federal income taxes you may or when you reinvest the proceeds from selling a stock that has risen in value. You may have a higher cost basis for the federal income tax purposes. If those tax rates rise significantly in future, that might minimize your total tax liability on that investment, but otherwise you may simply owe some taxes now and some later. As with individual stocks or bonds, when you sell or exchange a mutual fund outside of a retirement account, you may face federal income taxes on your gains, ordinary income taxes if you own the fund for a year or less, and capital gain taxes for longer term holdings. But mutual funds may incur capital gains when managers buy and sell holdings within the portfolio, and the fund will pass these gains on to the shareholders in form of a distribution. This means that even if you reinvest dividends and capital gains distributions, you may still owe federal income taxes. Those reinvested payouts are added to your cost basis when you do sell. As with individual stock, mutual fund dividends are taxable at either capital gain rates or the ordinary income rates, depending on whether they are considered qualified. To help potentially minimize taxable capital gain distributions, consider favoring funds with low portfolio turnover, such as exchange traded funds which typically follow a particular index. Actively managed funds may realize more capital gains due to higher portfolio turnover. The National Wealth Strategies team notes. So that was all about the topic that how to legally pay 0% $0 in the taxes as an investor. Hope this will have been beneficial for you. So do subscribe the channel for more videos.